Hello, this is Ernest Burley Jr., your CIA, your cool insurance agent, back at you again with some more great information on insurance. I'm a licensed insurance agent with over 30 years experience in the industry and clients all across the country in various areas of insurance. I specialize in all areas of insurance, whether it be auto insurance, homeowners, renters, condos, life insurance, long-term care, disability, um, business policies, church policies, the whole nine, okay? The purpose of this podcast is to educate you, to enlighten you, to empower you with clear, objective, unbiased information so you can make the right decisions for yourself, some good, sound decisions for yourself and for your family. Okay, that's the purpose of this. Get you the good information so you can make the right decisions for yourself, okay, and or for your family. Okay, so that's it. That's the purpose of the podcast. Let's jump into today's topic, okay? The topic for today's podcast is HSAs, a way to reduce health insurance and also healthcare expenses, right? Health insurance can be very costly, a very costly expense for people. I get that. I totally get that. Just like any other expense, though, you want to make sure that you can look at ways at reducing expenses whenever possible and whenever practical. Regarding the health insurance expense and also healthcare expenses or costs, sometimes a high deductible insurance plan is available, which will allow a person the option to open an HSA. HSA stands for Health Savings Account. An HSA is a great plan for most people. Well, I shouldn't say most people, a lot of people. Let me scratch that. Not most people, a lot of people. Let's just say that. If you're healthy and you don't use your health insurance that much, maybe a good option for you. Okay, a high deductible insurance plan may work for you. The HSA allows you to contribute money to it pre-tax, and it grows tax-free if the money is used for qualified medical expenses. That is a sweet deal. Did you hear what I said? So you put away money pre-tax, which means you reduce your taxable income. The money grows tax-free, which means the growth on the money is not taxable as long as it's used for a qualified medical expense. That is a great deal, right? Now, again, tax-free if used for a qualified medical expense. And this is not like an FSA. FSAs, you use it or lose it. No, this rolls over every year. The money keeps going tax deferred, tax deferred, tax deferred. It keeps growing year to year. And then when you pull it out for a qualified medical expense, no taxes, right? Now, also, after age 65, you can use the funds for any reason without a penalty, but you have to realize that you'll be taxed as ordinary income. The money will be taxed as ordinary income, just like your 401k plan or any other type of retirement plan. You start paying taxes on that money. When you pull it out, you pay taxes as ordinary income. So therefore, we can use the funds to supplement your retirement income. That's another sweet deal, because at age 65 or older, you can start pulling money from that HSA if you haven't used the money and supplement your retirement and pull from it just like you're pulling from your other retirement plans. That is a sweet deal. All right. Now, if you use the money before age 65 for any reason other than a qualified medical expense, there's going to be a steep penalty for that on withdrawals. So we don't want to do that. That penalty is like 20%. So that is something you do not want to do. Be under age 65 and pull that money out for something other than a qualified medical expense. So that means you pull out $1,000, they're going to whack you $200 because you didn't use it for a qualified medical expense. Once you get to age 65, then you can pull it for anything you want. Go buy a boat, go to Greece, go wherever, right? You just have to pay ordinary income tax on the money. But if you use that money for a qualified medical expense, even after age 65, tax-free. You don't pay any taxes on the money that you put in, nor on the growth. That is a sweet deal. So if that plan fits you, a high deductible plan, you can attach an HSA to it, health savings account to it. That's something you really, really want to look into, okay? But you have to make sure it's for you, right? Like I said, it's not for everybody. It's only for clients who, maybe you don't have like any health conditions, you're in great health, you rarely use your health insurance. So you could save money by reducing your taxable income, putting money into that plan. So whenever you do need it, you can draw from that for what you have to pay for as far as co-insurance, deductibles, qualified medical expenses, et cetera. Okay. And that's it for today's podcast. Okay. The recap is I want you to consider an HSA with a high deductible insurance policy. If it fits you, that's something we definitely want to look into. A takeaway, big takeaway, you reduce your expenses. Okay. And it's an excellent tax break for you, either tax-free or tax deferred. So it's a great way to reduce that healthcare, health insurance expense because you're putting away money. It's like a it's like a trifecta. It's a trifecta. Here's what you're doing. You're reducing your health insurance costs, right? By having this high deductible plan. So you're paying less premium, right? And then you're also reducing your taxable income, right? So if you earn $50,000 and you put, say, $2,000 a year into this HSA, you only pay taxes on $48,000. So you're reducing your taxable income. That's the second one. So the first one is reducing your health insurance costs by having a much lower premium because you have a high deductible plan. The second Benny is benefit, is that you reduce your taxable income. The third Benny is your money is growing tax-free as long as it's used for a qualified medical expense. And here's a bonus. Okay, this is a quadfecta. Is that a word? It's a quadfecta. Here's a fourth benefit. You can use it to supplement your retirement income, right? Because we just talked about once you get to age 65, you can pull the money out for any reason. Now it doesn't have to be a qualified medical expense for any reason and just pay ordinary income tax on it, just like you would with your retirement plan. Man, this is a great deal for some people. So take a look at it. Take a look at it. See if it's for you and your family. If it is, jump on that for sure. If it's not, then stay away. Okay. All right, that is it. So I want to thank you guys for listening every week. I really appreciate you listening and forwarding my podcast to others. I want to encourage you to do that. So please forward the podcast to others and ask them to do the same, and so on and so on, so we can make these podcasts viral. If you want to reach out to me or connect with me, my simple email address is my full name at gmail.com. So Ernest Burley Jr. at gmail.com. That's ERNEST BURLEYJR at gmail.com. Or you can call my firm at 301-262-2600. Again, that's 301-262-2600. All of my podcasts are on YouTube. So please go to my YouTube channel and subscribe. Try to get those subscribers up. Ask your friends and family and church members and coworkers to, hey, check out this guy, Ernest Burley Jr. That's my channel, just my name, Ernest Burley Jr. And check out the various podcasts and I have some snippets on there that are just a minute and on different areas: insurance, real estate, how to be successful in your career, all different types of topics there. So please check that out and, encourage others to do the same. That is it for today's podcast. I enjoy it every week sharing with you guys, and I appreciate y'all listening in. But that's it. So this is it. Ernest Burley's tuning off. Your CIA, your cool insurance agent, Ernest Burley is tuning off. Until next time, y'all be safe out there and take care. Okay.